It's yours. Thank you for being with us.
Thank you very much. It's a real pleasure to be here to discuss the July 18th proposals. I really appreciate it. So my name is Kim Moody. I'm a tax accountant with Moody's Gardner Tax Law in Calgary, as is already said. Throughout my career, I've volunteered extensively through various different roles within the tax profession to try and do my small part to help improve the education, dialogue, and administration of Canada's tax system so that it can continue to be one of the best in the world. I'm currently a co-chair of the Joint Committee on Taxation between the Canadian Bar Association and the Chartered Professional Accountants of Canada. Notwithstanding that the committee just submitted its landmark submissions regarding the proposals on Monday, I want to make it clear that my appearance and remarks today do not represent the views of the Joint Committee or any of the other associations or foundations that I've had the pleasure of being involved with. Instead, the comments today are mine and mine alone, but they reflect the views of many people with whom I've spoken over the past couple months. Canada's tax system is the envy of many other jurisdictions around the world, in my opinion, because of the general cooperation of all stakeholders, academics, government officials, bureaucrats, the judiciary, tax practitioners, and the business community. And they all have a vested stake to make sure that the system works. The experience since July 18th, 2017 has been a not-so-great example of what happens when all stakeholders are not involved, either intentionally or otherwise, in the debates and implementation of significant tax policy changes. Canada deserves better than what's being proposed with these proposals. My comments today are broken down between three distinct parts. First, the process of unveiling the July 18th proposals. Second, the problems with the proposals themselves. And third, concerns about where do we go from here. So firstly, the process. Where do I start? I have to say that the whole process of unveiling the most significant tax policy changes for private corporations and its shareholders since 1972 has been a lesson in what not to do. I appreciate that the government suggests that they've been studying these changes since they got elected. From the taxpayer's perspective, however, it started with a benign announcement and comments in the March 2017 federal budget, whereby the government announced that it was studying certain aspects of the taxation of private corporations and its shareholders, and those three were income splitting, buildup of passive assets, and conversion of dividends into capital gains. I was in the budget lockup in Ottawa for the 2017 federal budget, and for people like me, I mean, that's a great day for a geek like me. It's like a kid in a free candy store where you can gorge yourself with tax material. And many great tax practitioners were there, and we all had our guesses as to what the consultation paper would say. But there wasn't much talk. We were having some guesses and what have you, but really there wasn't a lot of detail, because really all the budget document stated was this statement. The government intends to release a paper in the coming months setting out the nature of these issues in more detail, as well as proposed policy responses. That's pretty much all that it said. I think it's fair to say that for the vast majority of tax practitioners, the release and contents of the consultation paper was a complete shock. And let me explain why. First, for two of the three pillars under study, income splitting and the conversion of dividends into capital gains, draft legislation explanatory notes were released. And not just a bit of draft legislation, but 27 pages of draft legislation and 47 pages of explanatory notes. And in my world, that's a lot. In my entire career, I can count on my left hand when draft legislation is released and such legislation is not passed materially as released. Releasing draft legislation as the so-called proposed policy response was unexpected, and this was not smelling like a consultation. Number two, the minister's letter attached to the consultation paper was one of the most shocking displays of arrogance I've seen in my career. Using language like closing loopholes to describe existing laws, the use of the populist phrase fair share, which in my world is a disguised way of increasing taxes, because in my world there is no such thing as fair share. Everyone needs to comply with the law, no more, no less. The use of class warfare language with this following statement. Our government is taking steps to address tax planning strategies and close loopholes that are only available to some, often the very wealthy or the highest income earners at the expense of others. That statement is disappointing and, in my view, unnecessary. In my opinion, this kind of language in the minister's letter was regretful, since it has, without doubt, contributed to the visible anger that currently exists within the tax and business community. Such language has made people feel that they've been tax cheats, when the reality of it is that the vast majority of small business owners are simply trying to eke out a living and comply with tax laws. Any good in the proposals was completely fogged out by the language, and understandably, since the language was the starting point. The misleading and aggressive language in the material caused, in my opinion, confusion and a delay in the business community, realizing that the proposals were not closing loopholes, but instead represented a massive tax policy change. Number 3, releasing the material on July 18th when much of the business community is either on holidays or trying to enjoy our short Canadian summer. Many told me that they believed this might have been done on purpose, such that Canadians would be caught unaware and unavailable. Many, too, suggested that this was perhaps a cynical move, which might also have led to visible anger within the business community. Number 4, the short 75-day consultation period, which just ended on Monday. The last time we had massive tax reform, such changes came out of the so-called Carter Commission, which commenced its study in 1964 and released its landmark findings 2 years later in 1966. After much debate and study, the government implemented its changes into law with much of the recommendations, but not all, coming out of the Carter Commission, and with the support of the greater business community, because they were involved in the consensus-building exercise at that time. That was roughly an 8-year period, with such recommendations still forming the foundation of our current system. Many people have told me that they do not believe that 75 days is sufficient to undo the long period of study, debate, implementation, and practice since 1964, and frankly, I agree. Number 5, we have seen a vigorous defense of the proposals by the minister and his department by way of print and social media, and a listening tour. The defense has been in response to what many economists and experts have noted, including me, are valid concerns. As an example, I referenced the Department of Finance's Twitter account. If you haven't looked at it, I suggest you should. I've never seen such propaganda being released by them, ever. Such a vigorous defense contributes greatly to the cynicism, or perhaps reality, that the consultation is truly not a consultation. Number 6, some of the speaking points by the PM, the minister, and other government officials has been very misleading, using the phrase that the proposals only apply to a wealthy few. For example, such proposals won't apply for people less than $150,000 of income. And apparently there are accusations that there's been a lot of misinformation and scare tactics being used by tax practitioners such as myself to fearmonger. The truth, however, is that the proposals as written will impact virtually all private corporations and their shareholders. There is no fear-mongering and spreading of misinformation in this statement. It is a fact. My peers and I are simply stating the truth. I am happy to defend that truth in separate in-depth conversations, because despite our government's vigorous defense, it cannot be clarified in sound bites. And notwithstanding some ridiculous suggestions made by some to simply wind up their private corporations to avoid the proposals, the fact is that private corporations are not used by the vast majority to simply save or defer tax. There are many valid non-tax reasons to incorporate, not the least of which is creditor protection. Such a suggestion shows a lack of understanding of the proposals, since a simple wind-up will not avoid all of the implications of the income-splitting proposals, as an example. And finally, a wind-up is just not that easy, and that's why I support an extended consultation period to explore all the impacts and benefits. All of these process points, and let's be clear, these are process points, are important for us to reflect on. Why? Well, as I mentioned earlier, the anger amongst the business community and their advisors is real. When the deck chairs are moved with misleading messages, it's only logical for the frontline stakeholders to react negatively. And let's be clear, the front line is not the Department of Finance and certain academics who have never experienced what it's like to be on the front line. Canadians deserve true engagement with all stakeholders to maintain the envy status of its taxation system and continue to be attractive to entrepreneurs and investment capital, most especially when there is competition from every corner of the world to invest in their country. I'll now move on to the actual proposals themselves. But before I do, it's important for me to recognize that some of the July 18th, 2017 proposals are actually good. But as earlier mentioned, the process points that I've just finished talking about have seriously clouded and tainted any good measures that might exist. Yes?
To inform you that we have 2 minutes left.
That's bang on.
Thank you.
So with that, I think it's fair to say that the draft legislation is some of the most complex and pervasive that I've ever seen. Many of my peers have said the same. And the Joint Committee submissions echo that, and on a whole bunch of other submissions. As I mentioned before, most of the small business community is simply trying to eke out a living, and they normally don't have big budgets to hire tax advisors like myself and others to help them interpret and apply the law. They are not large corporations with dedicated tax departments. They are simply job creators who care about doing a good job for their customers and hope to reap some financial rewards in their risk-taking. If I was a selfish person, I would simply shut up and not speak about the complexity of these proposals, since ultimately there'll be an even larger need for tax specialists like myself to assist business owners and their advisors. However, Canada deserves better, and so do the frontline businesses. A tax system that works for all is necessary. When the system becomes too complex, it fails. Compliance costs for both CRA spirals and along with taxpayer costs. These legislative proposals are certainly a step in the wrong direction in trying to simplify Canada's tax system. The proposals are rife with opportunities for double tax, significant tax increases for all, not just the wealthy few, problems with transitioning the family business to a non-owner person, significant tax increases upon death, retroactive and retrospective taxation, and numerous technical issues that are simply too complex to describe in my short time. Can the draft legislation simply be tweaked to sandpaper down some of the rough edges? Well, I guess we'll have to see. But if the length and depth of the Joint Committee submissions are any indication, some 150 pages in total, it'll be very difficult to. In my personal opinion, the sanding will need to be very significant, not just a few strokes against the grain. Given my short time, I'm just going to jump ahead here and suggest that my preference would be that the draft legislation be parked, along with the white paper on passive investment be parked, and instead let's look at what the good policy objectives are of the government, and let's involve everybody. And preferably such an engagement would take place with another tax reform like Carter. So let me close my remarks with some comments on my concerns about where we go from here. Some serious harm has occurred with the process that we've experienced. A helpful first step by the government would be an acknowledgement of some of the language used in the process fall was regretful. Such an acknowledgement might help heal some of the wounds and make visible some of the good tax policy objectives that the government is trying to implement. Next, I would recommend that it slow down and do this right. Overall, I'm concerned for Canada's entrepreneurial sector. There is an active dialogue that has taken place over the years to encourage the entrepreneurial spirit. And what I would suggest that is, I have written about how much capital I've witnessed leave Canada recently as a result of personal tax increases. I can tell you since July 18th, 2017, I have had more requests for meetings than I can actually handle in the short term. And I have meetings lined up to early 2018 about how capital is leaving Canada. The capital involved is not in the thousands, it's not in the millions of dollars, it's more than that. So all of this is not good for Canada, and ultimately the government should slow down, bring back certainty to our system. Let's maintain our envy status. Thank you.
Thank you, Mr. Moody. So